This week on Wealth Track, potential sea changes for investors. Two lifelong global economists and money managers, Nick Sargent and Bill Wilby, are on alert for unpredictable geopolitical and financial storms ahead. What they are monitoring and how they are investing is next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management Global Perspective, Rosalind P. Walter, and the Fairholme Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. For inspiration and levity, I occasionally turn to Lewis Carroll's classic Alice's Adventures in Wonderland. And as I survey the still unfolding saga of Brexit, spreading negative interest rates around the world, and the unsettling political scene in Europe and the US, two quotes seem particularly apt. As the Cheshire Cat told Alice, "We're all mad here." And as Alice opined, it would be so nice if something made sense for a change. This week's guests are trying to make sense of highly unusual and in some cases unprecedented developments. One of those is Brexit. After decades of opting into the European Union, albeit on some of its own terms, such as keeping the pound sterling as its currency, the United Kingdom opted out. The pressing question is, will Britain be the lone exception or the first of many to do so? A recent Pew poll found the EU was unpopular among substantial numbers of citizens in many countries. 71% of Greeks view the EU unfavorably. 61% of the French do. 49% of Spaniards and 48% of Germans agree. Since the financial crisis, there has been talk of Grexit, Greece's possible exit from the Eurozone. The latest candidate is Italy, with Quittily envisioned as its struggling banking industry reels under pressure from EU regulators. Then there is the impact of the unprecedented easing policies of central banks in major developed countries. This chart from Evercore ISI tells the story of the, quote, incredible balance sheet expansion of the big three. Since 2009, Federal Reserve, European Central Bank, and Bank of Japan balance sheets have increased a cumulative plus $8 trillion. Among other things, this helps explain why bond yields have plunged. And plunge they have, as illustrated by the line representing the average 10-year bond yield of the US, Germany, and Japan. The yield on the benchmark U.S. Treasury 10-year note has hit new lows in recent weeks, while yields on German and Japanese bonds are trading below zero in negative territory. In the week after the Brexit vote, Evercore ISI counted 18 more easing moves by central banks. How do these developments affect global economies and markets? Two experienced global investors are going to tell us. Nicholas Sargent, chief economist and investment strategist at Fort Washington Investment Advisors, the asset management arm of Western and Southern Financial Group, joins us for a rare television interview. A PhD in economics, Sargent has been international economist, global money manager, and chief investment officer for several major financial firms, as well as an official at the Federal Reserve Bank of San Francisco. William Wilby is with us as a Wealth Track exclusive. One of our great investors, now a private investor actively managing his own retirement account, Wilby was the portfolio manager of the award-winning Oppenheimer Global Fund, which was ranked #1 in its category for the 12 years he ran it. A graduate of West Point, Wilby has a PhD in international monetary economics and has held various international finance and investment positions at several top financial institutions, including the Federal Reserve Bank of Chicago. Both Sargent and Wilby believe the Brexit effect is far from over. I asked them why it is still so significant.
Well, I think, Consuelo, it kind of reinforces the budding trend away from globalization and towards nationalism, which is not a positive for the global economy long term.
And explain why it isn't, because, what's wrong with nationalism and what's not wrong with looking out for your own interests, what's wrong with loving your country, wanting to do what's best for your country?
Obviously, globalization produces winners and losers.
Right.
And the losers get injured by it, and everyone feels their pain. But the question for economics is, where is the maximum good, and where do you end up with the largest share of the pie? And I think globalization has resulted in the lifting of, 6 billion people out of poverty around the world. Now, people in the developed world, like those in America, may not have seen the spoils of that process nearly like those in some of the emerging markets,
Asia,
or other
for instance.
countries.
Right.
Asia, for instance. But it's the overall global pie has grown. I think the primary thing with Brexit is it's a political development. The economic part of Brexit is too early to tell, and it depends on how many things play their way out. I think even the impact on the UK is highly uncertain right now.
Nick, you were one of the few people that I know of who actually connected the dots pre-Brexit that this was going to be a significant market-moving event. What is your view now?
Well, first, my view was, and it's somewhat similar to Bill's, is that I viewed this primarily as a political event and not so much an economic event, meaning most Brits, if they realized the consequences for their economy and voted self-interest, would vote to stay.
To remain. Mm-hmm.
But they said, we're mad as hell with bureaucrats, we want our sovereignty back. And that's what just made it close. And I didn't understand why the smart money thought everybody was going to vote with the economics.
Right.
But why is it important to Europe? And here, Consuelo, the whole post-war order in Europe was, we are tired of fighting each other world wars. So basically, economic union was viewed as a way to end warfare in Europe, and as well as economic integration. So to me, the significance is this is the first move in the opposite direction. If I was confident it stopped at Britain's borders, maybe the consequences would be limited. But there's a whole series of events unfolding, including a French election next year.
Right.
And the real question
Where there are
is,
nationalists who could become even more popular than they are now.
So right now, if it was contained at the UK's borders, maybe the damage will be contained. But I think politics is going to rule the roost over the coming 12 months.
Nick, I know you told me on the phone a couple of days ago that this is the first time that you can remember in your long career on Wall Street where politics mattered as much as they do to the markets and to the economy. Just explain what's changed.
Yes. Well, first, often people will talk about elections, and I say, listen, it really depends on whether policies get changed. So what were the transformational elections? Positive. I'd say Thatcher, Ronald Reagan. They made a difference.
Right.
A lot of other times it doesn't matter. What I think is so concerning to me, and it comes back to Bill's theme of globalization giving way to nationalism, when did we last see this? Folks, study the 1930s, where people were mad because of the Great Depression, and we went nationalistic. And by the way, tariff barriers went up around the world, and that's what took a recession into a Great Depression. So my fear is not that we repeat history, but my fear is that the politics are reminiscent of what was taking place in the 30s.
Another sea change that we've seen since the financial crisis is the unprecedented easing that we've seen in central banks around the world, and especially in the developed countries, but also the interference in the capital markets that we've seen. And Bill, I know you are critical of the Fed's current low interest rates for longer policy. Tell me about your view on the Fed policy, and then we'll go to other central banks as well.
Well, I think this applies across the board because the ECB has adopted effectively the Fed's policy,
right,
as has the Bank of Japan. So we have a large swath of global GDP that has adopted these policies. I think there's an argument to be made that the Fed is creating the deflation it's trying to prevent.
And explain what the argument is.
I think you have to look at both the supply and the demand side. Any price movement affects both supply and demand, and interest rates affect both the supply of capital as well as the demand. And I think these low interest rates have aggravated an excess supply of real capital around the world, which is part of a deflationary environment. Monetary policy works through encouraging more debt accumulation, as does fiscal policy, one private debt, the other public debt. But we're glutted with debt, and people don't want to borrow, banks don't want to lend. Individuals, the issuers are full. They don't want any more debt. In addition, the Fed influences consumer demand. Low interest rates hit the largest demographic cohort, largest and fastest growing demographic cohort, which is the baby boom. And they can't get an income, they can't get a secure income stream. So all of this puts huge uncertainty about the future in people's minds, not to mention unprecedented monetary experiments has an impact on businesses' confidence in the future. And so I think on investment, for investment purposes as well as consumption purposes, the Fed has both increased supply and diminished demand, which is what a deflationary impulse is all about.
Nick, what is your view of what Bill is saying about Fed policy and central bank policy?
I basically agree with the whole point about the distortions in the capital markets. The one thing I will give the Fed credit for is at the worst part of the crisis, they made the right move.
Well, Bill agrees with you there. But
and what we're saying is that I think there's diminishing returns to getting rates lower and lower while there's increasing capital market distortions. Then also, Consuelo, as you know, I'm working on why are we seeing so many bubbles? And everybody wants to pin bubbles always on the private sector. Guess what? Often bubbles reside at the central banks when they extend too much credit. And the question then is not just is there a distortion in capital markets, but are they creating a mispricing of risk assets that can come back to haunt us?
And where are you seeing the most dramatic mispricings, or where are you seeing bubbles now?
Well, globally, I would say, ironically, China. Is where everybody has their focus. They are now in a situation where they've overextended credit. And so not just the IMF, but the Bank for International Settlements are all concerned. I do believe that China, they control their financial institutions. So I'm not calling for a collapse, but I'm basically saying their economy will continue to slow steadily because of poor resource allocation. You pay the price one way or the other.
And as investors, well, let me ask you one more question along these same lines. Negative interest rates. It's hard to believe the trillions of dollars now of negative interest rates that we're seeing in sovereign debt. Germany, Switzerland, Japan,
exactly,
and it's spreading. So what's the consequence of negative interest rates?
Well, one of the consequences is how much lower can you go? Because at some point, financial people will say, if you're going to tax me to put my money either with a central bank or commercial bank, guess what? I'll hold cash.
Negative interest rates.
Negative interest rates is the best sign there is of exactly what I was talking about earlier, which is the glut of credit and debt formation. It's like trying to take a guy who's just won Nathan's annual hot dog eating contest and offering him another hot dog. We have enough debt and credit out there. All the ratios around the world are at extremes for the last 100 years that we've seen. People don't want to borrow anymore because it stretches their balance sheet and puts them into more financial harm, and yet the Fed is incentivizing borrowing as its way to stimulate.
Let's talk about the U.S. I mean, and put on your economist hat, Nick, as well, is that looking at what's going on around the rest of the world, at least the developed world, I'm thinking the U.S. looks pretty good.
We are a very resilient economy. Two things help. We're a very diversified economy. When everybody was so worried about oil prices, some oil producers get hurt, but it helps consumers. But the other thing is we are not overly dependent on the external world. 12, 13% of the U.S. economy is exports, not Britain's 50%.
And what's your view as an investor?
I totally agree with that. As an investor, I think that the impact of the rest of the world on the U.S. is generally grossly exaggerated, especially in China. People get all upset about developments in China. China's impact on the U.S. is minuscule. We don't export a lot to China. I think the low interest rates, the negative interest rates, everything we've talked about increases financialization, which has social as well as economic impacts. And that's, I think, one of the reasons why US growth is kind of stuck in the mud. But from a market perspective, I look at a kind of a muddle through environment here. I don't see huge downside to the stock market. I don't see huge upside either because of earnings. I'm more concerned about the Japan model, that we just pancake for a long period of time. And then it becomes truly one of finding individual companies that can be outside the pancake, because there's no revenue growth. If GDP stays in this 1% to 2% range, there's no revenue growth for companies that's available to companies in the broad market, and margins are pretty close to peaks. So there's no earnings growth, and therefore the market doesn't go anywhere. But there are exceptional companies out there that are showing exceptional earnings growth. The problem is they're expensive, and the thing to do is to buy those companies when they're down.
Right.
And we may have come off a period where some of those expensive but companies that are growing at 10 to 20 times the market rate of growth may be attractive in here.
So I'm going to ask you about those in a minute, Bill, but let me just go through turbulent markets, because Nick's just written a new book. It's going to be published in several months, and it's called Global Shocks, an Investor's Guide for Turbulent Markets. So you do think the markets are going to be turbulent?
Yes.
How turbulent?
It remains to be seen. Again, I don't think Brexit is necessarily going to be the catalyst, but the way I ask it is, where are the risks? And I think I see, at the beginning of the year, I was over at a conference in Europe, and they hit me with the following issue. What happens if there's an external development and Europe goes into recession and interest rates are negative? What do you do? And the answer is,
Who knows?
who knows?
Right.
The second, more immediate risk is, this is the first time in my lifetime, both political parties in the US are anti-free trade. That's historically, we've been a nation that believes in competition. We can outcompete everybody. Now we're afraid of our own shadow. And if we were to get into a situation of potential, just talk of trade war, China, Mexico, Canada, believe me, the markets would freak out. So I'm not forecasting it will happen,
right,
but I'm trying to say what do I have to have my antenna on the lookout? And that's why I emphasize, I usually am not someone who focuses on political developments, but this is unforeseen.
Mm-hmm. Everyone, I'm sure, who's listening to this program is going to say, so what are they doing as investors? And Bill, you especially, because you're a private investor now, you're running your own retirement portfolio. How are you investing in this particular environment?
I'm fairly defensive.
Right. Defensive is...
Yes, I was a professional equity manager.
Yes, right.
So to me, I've got 65% in stocks, which is at the low end of the range for myself.
Right.
And with the remainder, I'm about half in long-term bonds and half in cash. And the reason I like long-term rather than short-term or intermediate bonds is because the bond equity correlation is negative. So in effect, bonds dampen portfolio volatility much better than short. The longer bonds dampen the volatility in the portfolio much better than short duration bonds do. So I've been very comfortable with that. It reduces the overall volatility in a portfolio. I think you can get less than hedge fund volatility with simple investments by using stocks and bonds together in an intelligent fashion.
And you are a bottom-up investor. You said that there are companies out there that you want to own for the long term.
What I like to do is collect great businesses that I think can grow faster than fairly pedestrian GNP growth, and buy those businesses when they're out of favor. And so I think this is I think there's a lot of opportunity to take advantage of the volatility that Nick's talking about. To the extent that we really do get some downside volatility, there are chances to pick up companies that are growing their revenues at 20% plus in a 2% revenue growth world.
Such as?
Amazon's growing revenues at 25% right now. Everybody thinks Amazon's expensive. It's on 3 times revenues. Okay, that's half the multiple of most pharmaceutical companies. So the problem is it keeps reinvesting its capital,
yes,
and it has an extremely high return on that capital. So their cash flow is growing at 20+%, but they're not showing accounting earnings. And so it's an interesting opportunity if you get a. Now, there's no question that Amazon's expensive on a PE multiple basis, but I think you can't use traditional PE multiples as a way to value companies in today's world where there's no capital in companies. It's like we were talking earlier, companies don't need to borrow money.
Right.
They're like banks. They generate enormous cash. Facebook, Google, these are phenomenal companies that have huge operating margins, much higher than what the market is. One of the reasons the operating margin of the market is as high as it is because a shift in the weighting of companies towards these large companies that have enormous operating margins, which has driven overall market margins up.
Nick, briefly, how defensive are your portfolios at Fort Washington, and what's your portfolio strategy?
Basically, on the equity side, our lead portfolio manager has done a marvelous job since the financial crisis. He'd basically been fairly bullish and constructive. He turned much more cautious a year ago. Partly, we are more value-oriented, partly for valuation reasons, and then partly it's just the recognition of increased risk globally. On the fixed income side, we're basically saying that again, the U.S. is in better shape than other economies. We still see opportunities in corporate and even high-quality, high-yield bonds. So we haven't changed the investment strategy.
Right.
But Consuelo, I never thought I'd say this in my lifetime. I've never recommended gold, and I'm not today. But I would say the following: watch again what happens geopolitically.
Right.
If it gets scary, for the first time in my life, I would contemplate gold. So I'm not there yet, but I've got it on the hip pocket.
This is earth-shaking news. One investment for a long-term diversified portfolio, Bill Wilby. What would you have us all on some of?
Well, I just finished talking about Amazon. I might as well put out Amazon as a long-term investment. And I have to preface this with it doesn't mean that now is necessarily the appropriate time to buy this for your audience. But I'm looking on a 20-year view, and what you have, it's the number one in cloud services in the world. It's Walmart, and it's also Netflix, all in one package, and it sells on 3 times revenues. I think these are great businesses. The returns on capital are very high. And if you project out that revenue growth rate and look at a PE multiple, all Amazon has to do is stop reinvesting 100% of its capital, and its earnings will skyrocket, and its PE multiple will shrink to single digits.
All right, and we are actually asking for like a 10 or 20-year investment. What would yours be, Nick Sargent?
It's interesting. Here we are talking about Europe, and most people's inclination is stay away.
Yes.
Honestly, I really don't know what to do in the public market right now. It's a coin toss. But I was just talking on our private equity funds. Guess what? We've made 3 European investment approvals. You say, are you out of your mind? And the answer is no. We're making a 10-year bet on those.
Right.
So we think that some of the pressure in Europe, is near term. Longer term, there may actually be on the private equity front. If you get the right type of fund, there's some opportunities.
All right, we'll leave it there. So great to have you both. Nick Sargent, thanks so much, from Fort Washington Investment Advisors. And it's so lovely, Bill Wilby, to have you on as a private investor.
Thanks very much, Consuelo.
Thank you both very much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is hold some safe haven assets: cash, U.S. Treasury bonds, gold, or all 3. When Nick Sargent says he is considering holding gold for the first time in his career, I definitely take note. Although he's not recommending buying it now, we and many other Wealth Track guests have been long-term advocates of always having a modest position in gold as an insurance policy against disaster, and traditionally a behavioral opposite to stocks. One of Morningstar's favorite vehicles to own gold is the iShares Gold Trust ETF. Bill Wilby holds long-term treasuries in his retirement portfolio as a non-correlated asset to dampen volatility. A top-rated treasury ETF is the Spider Barclays Long-Term Treasury ETF. And cash, which Wilby also holds, is a no-brainer because it can be both defensive and opportunistic. Well, next week we're going to discuss how to think about money and invest it wisely with two highly regarded financial journalists, Jonathan Clements, whose latest book is How to Think About Money, and Spencer Jacob, the author of just published Heads I Win, Tails I Win, Why Smart Investors Fail and How to Tilt the Odds in Your Favor. In the meantime, in the extra feature on our website, you can find out why after 30 plus years, Bill Wilby has unplugged from his Bloomberg machine, and Nick Sargent explains the biggest change he has seen in 40 years of investing. Thank you so much for taking the time to visit with us. Have a wonderful weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Thornburg Investment Management, Active Management Global Perspective, Rosalind P. Walter, and the Fairholme Foundation.